Warren Buffett did not become a multi-billionaire by luck or by starting a fast-growing multi-billion-dollar company like them Bill Gates, Jeff Bezos, Mark Zuckerberg, Elon Musk. But he became the richest man on earth in 2008. The richest. How did it happen? By making some of the smartest investment decisions any man can ever make. Now, his top 5 investment secrets is what I want to teach you in this video. Hi, I'm 𝐂𝐸𝐶𝐓 Strategy, and my job is to arm you with strategic insights that will position you and your business to win for a long time. Stick around. So now, straight up, how did Warren Buffett become so rich? Simply by knowing the right company to invest his money in and then leaving it for a long time to grow and mature. That means one of the key ideas and principles behind his investment is that he's able to predict that this company is going to remain profitable and healthy for a long time. Remember that the essence of strategy is to position you, that means the business, to position a company to win for a long time. And when we talk about winning, we mean profitability, sustained profitability. And whatever will make you profitable for a long time, it means that you have a durable competitive advantage. So everything that Warren Buffett looks for is this company benefiting from a durable competitive advantage? That's what will make the company profitable for a long time. Is it that durable competitive advantage? That's the key word. That's what he's looking for. And you know what? Accounting is the language of business. So the report card of a company is found in the financial statements. That's the report card. Everything you want to know about the health of a business, its past and its future, you can learn it from the financial statements. But you need to know exactly the metrics that you should be looking out for to know whether this company is benefiting from a durable competitive advantage. It's as simple as that. So there are 5 metrics that I'm going to be telling you about. These are top 5. There are many others, but these are the top 5 that really matter for you to know whether a company is benefiting from durable competitive advantage and for you to invest in. And it's not just about you investing as an individual. Even as a business, you can invest in another business. So the first thing you need to know, financial statements in publicly traded companies are found in annual reports. Okay, that's the best place to look. They have quarterly report and all of that, but the annual report is showing everything about the business for the whole financial year. Okay, annual report. So one of the key things there in the annual report is financial statements, and the financial statements is made up of 3 major parts: the income statement, the balance sheet, and the cash flow statement. So there are things that you're going to be looking at in these 3 different statements. Now, in the income statement, the very first major thing there is revenue. That's the first thing, revenue. How much is coming into the business? Okay? But revenue does not really show you anything. Okay? Revenue does not show you anything. So the metric, first of all, that you look at is the gross profit margin. Gross profit margin, which is simply revenue minus the cost of goods sold. But maybe for a company that does not sell physical goods, okay, products, you can call it cost of sales. So cost of goods sold is also known as cost of sales or cost of revenue. It's simply telling you about how much does it cost you to produce this value in the form of product or services that you're selling to the customer. So it's the cost of production. That's what that one is measuring. Okay, gross profit margin, revenue minus the cost of sales or cost of revenue or cost of goods sold. All right, so when you do that, whatever figure you get, divide it by revenue times 100/1 to give you gross profit margin. And for Warren Buffett, it should be more than 40, having a gross profit margin of more than 40, usually from 60 60, 60 something, 70 shows you this company is really doing well in the area of the production process. It has an efficient production process and a strong pricing power. That's one of the first things. Okay, then the next one. Okay, gross profit margin does not tell you. You can have a high gross profit margin and yet there's some other things you're not doing well. So the next thing we're going to be looking at is called SG&A, selling, general, and administrative. SG&A, selling, general, and administrative. It just means, apart from the cost of production, there are other expenditure in the business that, for example, advertising. You spend money for advertising, you spend money general. It's talking about different things you spend money on in the business. It can be fixing AC here, stationery, buying paper, buying fuel, travel costs, administrative costs, salaries for employees. All those is what is involved. So it's just the cost of running the business, operating expenditure. Okay? So for Warren Buffett, that SG&A, when it's 30% or less, that means it's fantastic. And when we talk about 30%, it means the percentage in relation to the gross profit. So SG&A of 30%, 20-something, or even 40-something% is very good in relation to the gross profit. But when you start having SG&A of 70-something, 80-something above, it means that the company is not benefiting from a durable competitive advantage. The company is not healthy. The company is not managing its general operations well. That cost is too high. Are you getting it? That's one metric he looks at. They want to know the health of a business so that they are managing themselves well. Are you getting it? So the next thing you look at in that income statement, which is the most important, is called net earnings. Your net earnings, you've subtracted every other thing. The expenses for research and development, interest, taxes, depreciation, amortization, every other thing. Okay? Whatever remains is called net earnings. Okay? So you subtract cost of goods sold, SG&A, interest, taxes, everything expenditure, subtract it from revenue. You get net earnings or net income. A net income of 20% to 30% in relation to revenue. Okay? I mean, let's say you have a revenue of $100 million or 100 million naira. And then when you remove every expenditure, the net earnings, what is remaining that is truly yours, is like 20 million. That's 20%. That business is doing very well. Net earnings of 20%, 20-something percent, 30%, fantastic. In fact, even 15%. That business is doing well. But then it's not just the earnings for a particular year, it has to show a historical upward trend that your earnings, net earnings, are accumulating and they are growing. That's what Warren Buffett looks at. So the next thing is the balance sheet you want to look at. So balance sheet is just telling you about an equation, that both sides of the equation must balance. Asset equals liabilities and equity. Asset is what the business owns. Liability is what the business owes. And equity is what the owners of the business own. What the business own and what the owners of the business own are two different things. So asset equals liability and equity. Sometimes you call it owner's equity, or for a publicly traded company, you call it shareholders' equity, because the shareholders that actually own the company. Are you getting it now? Okay? So the main thing you want to be looking at in that balance sheet is long-term debt. So when you look at long-term debt, you compare it with the earnings and you check whether from the earnings of this business, are their earnings high and big enough to pay off this long-term debt within 3 to 4 years? That's the question. You look at the size of the long-term debt and you check the earnings. Can they use their earnings to pay off their long-term debt within 3 to 4 years? If you look at their debt and it's so huge that you know that this company cannot pay it off within 10 years, it's a sign that this company is not very healthy. It's accumulating too much debt. It's using too much debt to finance its operations and to expand and all of that. It's unhealthy. Are you getting it? So you compare the long term. So the size of the debt is not what matters. It's the size of the debt in relation to their earnings. Can they pay it off within 3 to 4 years? If the answer is yes, that company is a healthy, strong company that is benefiting from a durable competitive advantage. You want to invest in such a company. Are you getting it now? So the last major thing you want to check for is retained earnings. Retained earnings. Now, what do we mean by retained earnings? Retained earnings is actually gotten from net earnings or net income. So when you get your net income, that's what is remaining, your major profit that you have made from this business. So there are different things you can do with your net income. Number one, you can use it to invest in another company. Like I said that businesses invest in other business. Number two, you can use it to pay dividends to shareholders. Number three, you can use it to expand the business. That's you reinvest it in the business to expand your operations. Then the fourth one is that you can do nothing with it. You just keep it. It's called retained earnings. Okay? So it's accumulating. So your retained earnings needs to be growing over the years. When you check retained earnings, you need to be keeping some retained earnings and it's growing. Any company that is spending every of its net income, maybe you are expanding, or just paying dividends, you're not keeping it and it's growing. It's not a very good sign. Okay? So you might have a very good net income, but how are you using it? Are you keeping it to grow? Okay? So that retained earnings has to also show a historical upward trend of growth and accumulation. It's a sign that this business, the managers of this business are thinking well. They have sense. That's what it shows you. It's a sign of health of the business, and you want to invest there when you see upward growth. So I'll give you one final bonus, okay, which is the sixth one, bonus. And that one is you check it in the cash flow statement. And that is capital expenditure. Capital expenditure needs to be less than 25% of the net earnings. So when you have a very large company that is investing so much in capital expenditure, it's not very healthy. You're investing too much of your income, your net earnings, into equipment and plants and all those capital expenditure. A business that is capital intensive, it's not a very good sign. Warren Buffett does not like investing in such companies. So when you have a capital expenditure that is not more than 25% of your net earnings, love such companies. It's a good sign that this company is benefiting from durable competitive advantage. Are you getting it now? So these are the top 5 secrets plus a bonus that you check for when you are checking financial statement, reading financial. These are the things. Go and look at those things. Okay? You are wise. This is what we call financial literacy. You need it as a business owner to make wise financial decisions, both for your business and when you want to invest in other businesses. And it's going to help you to win for a long time. So I want you to subscribe to this channel. So many things, valuable things are going to be dishing out. I'll position you to win for a long time. I'll see you in the next video.